Chapter 26, Examples for Principles of Accounting 2. In Chapter 26, we talk about capital budgeting. So capital budgeting is different than regular budgeting because in capital budgeting, we're looking at large projects that span multiple years, where with most budgeting, we're looking at shorter term projects such as just our operations, our yearly information, or month-to-month information. So when we're looking at larger investments that are going to tie up money for multiple years, we need to make sure we're making good decisions about those investments. We're going to go through a couple of these examples. This first example, we have a record company who's going to purchase another company. And the purchase price is $600,000. They believe the investment is going to increase their annual net cash flows by $250,000 and last for 4 years or have a 4-year useful life with a salvage value of $40,000. It's a high risk investment, so they're looking at a minimum rate of return of 20%. So we're asked to compute the payback period and the net present value. The payback period is simply the initial investment divided by the annual cash flows. This tells us when our cash flows will cover the initial investment. So our initial investment of $600,000 divided by our cash flows of $250,000 or 2.4 years. For the net present value, we need the net present value of both our annual cash flows and the salvage value. To calculate the net present value, we get a factor off of a table called a time value of money table. So we have future value and present value tables. For the annual cash flows, we will use the present value of an annuity factor. And for the salvage value, we will use the present value of one factor. So when we're making these decisions, for the $250,000 annual, we have a required minimum rate of return of 20%, and this project is a 4-year project, which means that our factor is 2.5887. For the salvage value, that is the present value of $1. Our factor is still 20%, and we're still looking at 4 time periods. That value is 0.4823. We take the cash flows times the factor, so we get the present value of the cash flows and the present value of the salvage value. For the net present value of the investment, we add those together and we subtract our initial investment price. So the net present value of this project is $66,467. If a project has a positive net present value, that means that it meets or exceeds the required minimum rate of return. So we would normally accept that project and say yes to it. Non-financial factors we should consider. Well, when we're talking about the music industry, so they already say this is high risk and that they're making predictions about music demand for 4 years. So non-financial things that they might have to consider are, will the demand actually hold steady for 4 years? How good are their predictions about estimated cash flows? Is there a potential that any expenses that they would be looking at this project could be higher than predicted. Those are all different kinds of things that they might want to think about. In this example, we're thinking about taking on a new product line. So we have a toy company that wants to start making toy dinosaurs. They have done some initial analysis and decided that they can sell 80,000 toys a year. And then they have some other costs about the project. In order to make the dinosaurs, they have to invest $350,000 in design molds and equipment. And they predict this will have a 3-year life with a $20,000 salvage value. Depreciation is straight line, and they have a federal or combined income tax rate of 40%. So what we want to do is set up an incremental income statement for this information. We've done that down here. Remember from a couple of chapters ago that incremental analysis is the difference between two options. So what happens only if they take on this investment? Well, we have estimated sales, 80,000 units at $6 per unit. So 80,000 units times $6 per unit. Our variable costs are $2.50 per unit. So 80,000 units times $2.50. Our fixed manufacturing costs are $45,000 and selling and general administrative expenses are $55,000. Our depreciation expense is 3-year useful life. We have a $350,000 initial investment and a $20,000 salvage value. We're using straight line depreciation. So in straight line depreciation, we take cost minus salvage value and divide by useful life. So our yearly depreciation expense is $110,000. We take our revenues minus all of our expenses added together, and we get our income before taxes. Our tax rate is 40%. Take 70,000 times 40%. And our estimated increase in annual net income from this project is $42,000. So we've done the first part, net income. The next thing we need is annual cash flows. So if you remember from Principles of Accounting 1, that net income and cash flows are not the same when we prepare a statement of cash flows. So we take net income and we add back non-cash expenses. Our major non-cash expense is depreciation. So we take our net income and add back depreciation to get our annual cash flows. Here we're asked to compute the payback period, the return on average investment, and the net present value of this project. So we have payback period, the annual return on investment, and the net present value. So payback period, remember, is the initial cost divided by the annual cash flows. 350,000 divided by 152,000. So our payback period is 2.3 years. The annual return on investment is also called accounting rate of return. And this is an accounting number. So we use, instead of cash flows, we use net income. This is net income divided by average annual investment. So the average annual investment is our cost plus salvage value divided by 2. So for our annual return on average investment, we take net income and we divide it by, we add together the cost and the salvage value, and we divide that by 2 to get our average annual investment. Our net present value, we have annual cash flows and our salvage value. So our annual cash flows are 152,000. Salvage value is 20,000. And now we need our present value factors based on a 15%. So for the salvage value, we can do present value for 1. It's 15% and it's a 3-year project. So 0.6575 is our factor. And for our annual cash flow, we use the annuity. So present value for a $1 annuity, 15% at 3 years, 2.2832. We add those together, and then we subtract the initial cost, and that gives us our net present value.